Last but not least, here we have some foreign exchange policy. As you look at it, governments do have more power to influence that nominal exchange rate. Exchange rates are important to countries when they export and import. Sometimes it causes some problems, like when a country tries to manipulate their currency and another country feels like, oh, well, they're just depreciating their currency so that their goods seem cheaper and results in better trade deals. Um, Countries can do that. Um, and if a currency isn't expensive, like foreign people will definitely find those goods inexpensive, and your exports are going to go up. So if you want to stimulate a little bit of growth in your country, depreciating your currency is not a bad idea, because then people are going to see your goods as cheap and they'll trade more with you. There is some things in here about like exchange rate regimes and fixed rate exchanges, etc. Most of us are going to use a floating exchange rate where the government's just going to say, hey, you know what, whatever the market fluctuates or is like whatever it is, that's where your exchange rate's going to be. Let people kind of decide. How can exchange rate be fixed? You know, when you do have certain countries that are going to say, hey, this is the exchange rate, then even though there's market forces saying things that are different, they can always, um, you know, keep it the same in their country, and then it becomes kind of weird because the goods should be more expensive or it should cost you more, and they're purposely like making it less. Um, that can happen. You can read about that if you want. Um, there's cases for both, right? So there are cases for a fixed exchange rate. Um, it's interesting to look at, I guess, in terms of like a country that could do that. We can't do that in the United States, so there's also cases against that. And then as you look at exchange rates and macroeconomic policy, um, whoops, when you look at why like Britain didn't adopt the euro, right? So when they were in the European Union, they kept their own currency. Um, it's interesting because if you have your own currency, then you can do things like have some appreciation and depreciation of your currency, and you're not relying on some other currency to do that. And there is something about having control, and you can see obviously Britain with Brexit is trying to maybe even get more control than being in the European Union. Devaluation, revaluation of fixed exchange rates, whoops, uh, adjusting the rate or devaluating and reevaluating. Devaluating is a reduction in the value of the currency that is set under some sort of fixed rate thing. A reevaluation is an increase in the value of a currency that is set underneath a fixed rate regime. You can look at that again. I'm sure if you go into macroeconomics as a major, they're going to focus on that or focus on different types of money policy, etc. Here you have some monetary policy under a floating exchange rate. You can see how ability to pursue independent monetary policy, and monetary policy results in those changes in exchange rates that lead to other macroeconomic effects that we've talked about in the past. Changes in interest rates have direct effects in the exchange rates and influence net exports. That is true because if your interest rate is high, countries are going to want to try to come here with their money to invest. So they're going to supply more of their currency, demand more of your currency, and that's going to start moving those lines around to be able to see how much more currency is demanded of somebody, and it'll lower theirs, raise yours in terms of how much value your currency has versus theirs. There are shocks that can happen from abroad. If all of a sudden, Russia decides to produce a bunch of oil and Saudi Arabia is like, okay, we're going to do that too, that is going to be a big deal. And so now all of a sudden you're going to see different things happen, when something like this occurs. So we're not just dealing with a business cycle for the United States anymore. It's a global business cycle. When we go through a recession, it's a global recession. When we have depressions now, it kind of is the same, right? As you look at the exchange rate regime and how they could kind of influence that, maybe. And floating exchange rates really, though, should kind of lessen the impact because as things are happening in a certain country, all of a sudden it's like, oh, it'll adjust because now people either want more or less of somebody's currency, and that will, of course, make trade different. It'll make people want to invest in other countries different. So a floating exchange rate tends to like moderate that business cycle a little bit. Last but not least, this is your putting it all together. This would have been the last thing we would have done. What happens in a normal econ test, they always give you some sort of starting point. There's always some sort of event that happens. Then there's initial effects of the event, and then of course there's always something that's going to happen after the event is over, right? Or what's going to happen now that this occurred? That's how a typical macro question would be worded. Starting point a lot of times is an aggregate demand, aggregate supply model. They're going to say, oh, here's the equilibrium, you're in an inflationary gap. Oh, here's the equilibrium, you're in a recessionary gap. Now you're going to have to do something to fix it. And then of course, all these things are going to be like involved, right? In terms of fixing something. You're going to say, oh, look, there's my recessionary gap. I need this to happen. Oh, there's my inflationary gap. I need this to happen. What is the effect of the shift happening? How are you going to fix it? And then, of course, how does this idea of exchange rates and foreign markets that's usually the secondary part, where you're going to see, oh, now that the price level is higher, what's going to happen? Are more people going to come into the country with your money, or are more people going to try to leave your country to go someplace else? What's going to happen if your money is worth more now? Are you going to see net exports go up or net exports go down? Are people going to choose to invest in your country? Are people going to choose to invest their money elsewhere? So those are kind of how this last part, it's usually like if the question's laid out, the last part deals with something with foreign exchange markets, etc. And of course, this long run effect. Well, what's going to happen? What happens to the government budget? Or what happens if they decide to spend and then there's crowding out happening? Are people going to have economic growth in the long run, or is it just going to, what's going to happen overall? So as you look at this last section, it kind of is, it deals with that foreign exchange market. A lot of times there would have been just a question on that in the free response alone, and it would have just given you a couple countries and told you what's happening, and then you would have had to say, oh, I'm going to draw two graphs, and someone's going to supply more of this one and demand more of that one, and then you have to show what's going to happen in terms of like euros to dollars and dollars to euros. They didn't have to do that this year, but if your econ professor would expect you to know something like that you can probably look it up on a quick little review video, and then you're probably set. So there you go, kids. That was the end of all things macroeconomics. Again, good job sticking it out this year, and good luck in college.